I'm your rich uncle. I want to see my family win. Follow my advice, and you'll be the rich uncle in your family. What if the next recession is actually your biggest opportunity? While most people panic, cut back, and wait for things to go back to normal, a small group of people quietly build wealth behind the scenes. Recessions don't destroy money, they transfer it. Prices drop, opportunities rise, and those who know where to look can buy assets at a discount, start businesses with less competition, and position themselves for massive gains when the economy recovers. In the next 30 seconds, I'll show you how the smartest people use economic downturns to get richer, while everyone else falls behind. Today, we will talk about how to use recession to get rich. So before we start, make sure to hit the like button and subscribe to my channel. Why recessions create more millionaires? A recession is usually described as a period of economic decline, rising unemployment, falling markets, and financial stress across society. Most people associate it with fear, loss, and instability, and for many that is exactly what it feels like. However, what is rarely understood is that recessions are also one of the most powerful wealth creation environments in the entire economic cycle. The reason is not that money suddenly appears, but that it changes hands. Assets that were once expensive become cheaper, struggling businesses are sold at discounts, and emotional decision-making leads to massive financial mistakes from the majority. At the same time, a smaller group of prepared, disciplined, and strategically thinking individuals quietly use these conditions to build long-term wealth. The truth is simple: recessions do not destroy opportunity. They compress it into a short window where those who are ready can move ahead financially faster than at almost any other time. Understanding the wealth transfer effect. To use a recession to get rich, the first concept to understand is the idea of wealth transfer. In stable or booming economies, prices are often inflated because confidence is high and demand is strong. During a recession, fear takes over. People rush to sell investments, real estate becomes harder to afford, and businesses struggle with reduced cash flow. This forced selling leads to undervaluation. Stocks drop below their long-term value, properties are listed at reduced prices, and even profitable companies may appear weak simply because of temporary economic pressure. Wealth does not disappear in these situations, it is simply transferred from those who panic to those who remain calm and liquid. This is why many of the wealthiest individuals and institutions often expand their holdings during recessions rather than retreating from the market. The importance of liquidity and cash positioning. Cash becomes one of the most powerful tools during an economic downturn. In normal times, cash is often seen as idle money because it is not actively growing like investments. However, in a recession, cash transforms into opportunity capital. When asset prices fall, those with available liquidity can act immediately, while others are forced to wait or sell assets themselves. Building cash reserves before and during a recession allows you to take advantage of sudden opportunities such as discounted stocks, real estate bargains, or even struggling businesses that can be acquired below their true value. This is why financial preparation is critical. It is not just about saving money, it is about ensuring you have the flexibility to move when others are stuck. Managing debt to avoid financial pressure. Debt plays a very different role during a recession compared to a stable economy. When income is steady, debt can sometimes be managed easily or even used strategically. However, during a downturn, uncertainty increases and debt obligations can quickly become a burden. High-interest debt, in particular, limits flexibility and increases financial stress. To use a recession effectively, reducing unnecessary debt becomes a priority. This does not necessarily mean avoiding all forms of leverage, but rather ensuring that your financial foundation is stable enough to withstand income fluctuations. People who are over-leveraged often find themselves forced to sell assets at the worst possible time, while those with low debt have the freedom to hold and wait for recovery. Investing when fear dominates the market. One of the most powerful principles of wealth building is that the best investment opportunities often appear when fear is at its peak. During recessions, stock markets typically decline, sometimes sharply. This creates panic among investors, leading many to sell at losses. However, for long-term investors, these periods often represent discounted entry points into strong companies. The key is not to chase quick profits but to focus on long-term value. Businesses with strong fundamentals, solid balance sheets, and sustainable demand often recover and grow significantly after recessions. By investing consistently during downturns rather than reacting emotionally, individuals can position themselves for substantial gains when the economy stabilizes. Real estate opportunities during economic downturns. Real estate is another area where recessions create unique opportunities. Property markets often slow down because buyers become cautious and lending conditions tighten. This leads to lower demand and reduced prices in many regions. At the same time, sellers who are under financial pressure may be more willing to negotiate or accept lower offers. For prepared investors, this environment allows for the acquisition of properties at discounted values. Rental demand may also remain stable in many areas, creating potential cash flow opportunities even during economic uncertainty. The key advantage in real estate during recessions is not speculation, but long-term positioning, buying quality assets that will appreciate once the market recovers. Business acquisition and entrepreneurship opportunities. Recessions also create a wave of business failures and distressed assets. While this may seem negative, it opens the door for strategic entrepreneurs. Many businesses fail not because they lack potential, but because they run out of cash or cannot survive temporary drops in revenue. These businesses may still have strong customer bases, valuable systems, or established brands. Investors and entrepreneurs who understand this can acquire such businesses at significantly reduced prices, restructure them, and profit from their recovery. Additionally, starting a new business during a recession can be cheaper due to lower competition, reduced marketing costs, and more available talent in the job market. Some of the most successful companies in history were built or expanded during economic downturns. Increasing personal income stability through skills. Beyond investing in business, one of the most important strategies for using a recession to get rich is developing high-value skills. Economic downturns often lead to job insecurity, making it clear that relying on a single source of income is risky. Skills such as digital marketing, sales, software development, financial analysis, and content creation become extremely valuable because they allow individuals to generate income in multiple ways. The more adaptable and skilled a person becomes, the more resistant they are to economic shocks. Instead of depending entirely on employers or market conditions, skilled individuals can pivot, freelance, or create independent income streams. Psychological discipline and emotional control. One of the most overlooked factors in wealth building during a recession is psychology. Most financial losses during downturns are not caused by lack of opportunity, but by emotional reactions. Fear leads to panic selling, hesitation leads to missed opportunities, and uncertainty leads to inaction. Wealth builders, on the other hand, focus on long-term cycles rather than short-term fluctuations. They understand that recessions are temporary, but financial decisions made during them can have long-lasting consequences. Emotional discipline allows them to act when others hesitate and stay consistent when others withdraw. Right, my future millionaires. That's a wrap for today. If you got some value from this, don't just sit on it, hit that like button. Share this with someone who needs to hear it. And of course, subscribe to the channel so you never miss out on more money-making secrets. Turn on those notifications because wealth waits for no one. Stay smart, stay hungry, and I'll see you in the next one. Let's get rich.